How have you approached investing and the methodology around your investing as a side your business post this? Like, you got the business back on track, you got the lifestyle and a family thing happening and your own home. How are you thinking about what you invest in and your methodology there? As I know we have different views here, let's just say.
Well, in my early days of investing, when I had a much lower income, I bought where I could afford, and I partnered with others to get the money for my first few deals. And I put in that sweat equity and renovated and, moved into doing small subdivision and development. And I also sold most of those properties, as you know, and was at different times as well. I was turning over properties just to realize profit and try to accelerate my way forward. So there was times when I sold when I didn't have to. And there's a lot, when you look back, there's a lot of purchase costs, selling costs, tax that you pay. And it did help me chunk up money quickly when I needed to, but it and it helped me put it into the business and do these other things. But it was also very wasteful. So over the last few years, when rebuilding my portfolio, I've had to decide whether I focus more on cash flow in buying lower priced properties or capital growth from higher priced, more blue chip properties with a proven history of performance. At least I saw the choices being, more towards income or more towards growth. And with my business profits being much higher and very consistent, and thankfully, property management's a pretty consistent type of business. So, we're working with people for long periods of time, and we've got that, continuity. So I decided that I'd use that really strong cash flow to buy the much higher priced properties that have a high land component in amazing locations. And my criteria was to find stuff that had at least an 8% average annual growth rate over the last 30 years. And I knew from looking at more of the income properties, they typically land at 4 to 5% average annual growth rate over 30 years. So when you compound that out, it can make a real big difference. Even 2% on a median house price of $500,000 over 30 years is $1.1 million. So the growth was more important for me. Each investor chooses differently depending on their situation. And if I didn't have the strong business cash flow, I would have lent more towards cash flow sooner. So I also wanted that development potential so that later on I could build and convert the properties to producing higher income if I wished. And that made a lot of sense to me, especially because I was pretty comfortable with developing and it wasn't in my immediate plan, but it was in a 10 or 20 year period. If I want a project, if I'm bored, if I want to convert the portfolio to producing more income, and that might happen sooner if interest rates stay up for a while, then I'd look at developing some of those properties and converting to having better buildings on them that produce more rent. So my primary reason for doing this is that in bottom line dollar terms, having more of your return from capital growth of the land component of the property and less from the income component of the building on the property means that your increasing price is also able to compound out with less tax being paid on it until you sell or may never sell. So if the income component was higher, your rent was higher, you'd be paying more tax on that component along the way. And so I'm choosing to take more of my overall gain as capital appreciation on the property. Does that make sense? I did want to mention that there's some trade-offs to my strategy too. Like I just spoke about the positives. What about some of the negatives to this strategy too? Because with increasing interest rates, properties become more and more negatively geared. And especially over the shorter term, that can be really hard to hold if you don't have that strong cash flow. And when choosing this strategy, it was more important for me to have that certainty of capital growth and consistently compound that capital base. But the other part of my overall financial plan is to diversify into other assets that create the income then. So it's not just all, there's always these camps, like, are you in capital growth camp or income producing camp? But what about creating a overall balanced portfolio camp? What about the asset allocation to put all these pieces together? So I'm not a proponent of one or the other. And my overall financial plan is about balancing the negative out in the coming years. I'm piling more into index funds, looking at a commercial property, and potentially higher income producing residential like a share house. And that's going to be the next phase, the next season, if you will, that I'm going to get into. And of course, you can also combine paying down of debt and developing some of the properties, and while having rents continue to increase. And you not only then have that sizable asset base, but you can have the passive income and convert it more towards that, and I guess not rely on the sale of my business. So I didn't want to leave out the other side to that.
Hey, fellow business owner, if this topic and value-packed short video has resonated with you at all, and you want to dive deeper into being a full stack business owner, check out the full episode by clicking the link on your screen or in the description right now.